A real estate investment trust reports a profit. The building it owns is deteriorating. Both statements are simultaneously true, and the accounting framework that makes them simultaneously true is not a bug in the system. It is the system. The specific accounting mechanism is depreciation, or more precisely, its absence from the metric that REITs use to report financial performance to investors. Funds from operations, universally abbreviated FFO, which is calculated by adding back to net income the depreciation and amortization charges that generally accepted accounting principles require companies to deduct from earnings. The logic for adding back depreciation is, on its face, reasonable. Real property generally appreciates in value over time, unlike manufacturing equipment or computer systems, whose physical deterioration directly reduces their productive capacity. If a building that cost $100 million to construct is worth $150 million 30 years later, the $100 million depreciation charge that GAAP has subtracted from earnings across that period does not reflect economic reality. It reflects an accounting convention that was designed for assets that actually lose value, applied mechanically to assets that often gain it. That logic is correct in the cases where it is correct. It is misleading in the cases where buildings are not appreciating, or where the physical deterioration of a building whose book depreciation has been taken has produced a property that requires substantial capital investment to maintain its competitive position. Investment that REIT accounting does not subtract from FFO, and that the FFO-based distribution model does not require the company to fund before paying distributions to shareholders. The REIT accounting problem is not that GAAP depreciation is a poor measure of real estate value. The problem is that FFO, by removing depreciation, also removes the signal that a building's physical condition is deteriorating faster than the market is appreciating it. Subscribe now, because this episode is the accounting layer that every other case file in this archive was built on top of without being explicitly named. The funds from operations metric was formally defined by NAREIT, the National Association of Real Estate Investment Trusts, in 1991, as a standardized measure of REIT operating performance that would allow investors to compare REITs across different portfolio compositions and depreciation schedules. The definition is straightforward. FFO equals net income as computed under GAAP, plus real estate depreciation and amortization, minus gains from the sale of real estate. The addition of depreciation and amortization back to net income is designed to remove the accounting distortion that depreciation creates in comparing real estate company performance to non-real estate companies, which do not depreciate their primary assets on the same schedule. The FFO metric's adoption across the REIT industry was rapid and complete. By the mid-1990s, virtually every public REIT reported FFO as its primary financial performance metric, and the REIT investor community evaluated REITs on FFO yield, the FFO per share divided by the share price, rather than on earnings per share, which the depreciation charges made appear consistently lower than the company's actual cash-generating capacity. The accounting problem this episode documents emerges from the specific use to which FFO is put. REITs are required by federal tax law to distribute at least 90% of their taxable income to shareholders in order to maintain their REIT status and the associated tax advantages. The distribution requirement, combined with the FFO metric's exclusion of depreciation from the earnings figure, creates a structural incentive to distribute capital to shareholders that the building's physical condition requires for maintenance and renovation. When a REIT distributes FFO to shareholders, instead of spending it on capital maintenance, the distribution is not coming from earnings in the conventional sense. It is coming from the building's future competitive position, the investment that is not being made because the FFO is being paid out instead. The specific mechanism by which REIT accounting produces the deterioration pattern this channel has documented across multiple case files involving REIT ownership is most visible in the capital expenditure data. REITs disclose their capital expenditures, which represent the actual cash investment in maintaining and improving their properties. The relationship between capital expenditure and FFO is the specific ratio that reveals whether a REIT's distribution to shareholders is sustainable. whether the company is maintaining the physical standard of its properties while distributing to shareholders, or whether it is distributing capital that the property's physical condition requires for maintenance. The hotel REIT sector's capital expenditure patterns are particularly revealing, because hotel properties have higher maintenance capital requirements than office or industrial properties. The guest-facing physical standard that generates RevPAR premium requires continuous renovation investment, at a level that typically runs 4 to 6% of hotel revenues per year as a minimum standard. A hotel REIT that is distributing 90% of its FFO to shareholders and spending 2 to 3% of revenues on capital maintenance is not maintaining its properties, it is harvesting them. The FFO it is distributing includes the portion of the building's future competitive position that the capital maintenance spending would have preserved. This specific dynamic, FFO distribution at the expense of property maintenance, is the accounting mechanism underlying the physical deterioration that this channel has documented in the leveraged hotel acquisitions, CMBS-financed properties, and private equity-owned grand hotels across its 89-case archive. The accounting framework makes the deterioration invisible in the financial reporting until the RevPAR decline and covenant breach that case file 060 documents as the hotel bankruptcy anatomy make it visible in the legal proceedings. The building was deteriorating. The REIT was reporting profits. Both were true. The adjusted funds from operations metric, AFFO, represents the industry's attempt to address the capital maintenance problem that FFO's depreciation add-back obscures. AFFO subtracts recurring capital expenditures from FFO, producing a figure that better reflects the cash available for distribution after maintaining the physical quality of the property portfolio. AFFO is a better measure than FFO for the purpose of evaluating distribution sustainability. It is used by sophisticated REIT analysts and by institutional investors who understand its construction. It is not the headline metric that most REIT investor communications lead with, because FFO is higher than AFFO, and higher numbers are more attractive to the retail investor base that REIT distributions appeal to. The gap between FFO and AFFO across the REIT industry is the aggregate measurement of the capital maintenance investment that the REIT sector's distribution model is not funding. It is not a gap that is uniformly sinister. Some REITs fund capital maintenance conservatively and distribute from genuine free cash flow. Some REITs fund capital maintenance aggressively and distribute less. The ones that fund capital maintenance inadequately, while distributing at FFO, are the ones whose properties this channel has documented encountering the physical deterioration, RevPAR decline, and covenant breach sequence that the accounting had made invisible until the lender's workout department made it legible. The REIT accounting problem is not that the accounting is dishonest. It is that the accounting structure removes the signal that would alert an investor to the specific risk that a REIT's distribution model is cannibalizing the property's future competitive positions to fund its current distributions. By the time that signal becomes visible, in the covenant breach, in the special servicer assignment, in the bankruptcy filing, the capital that would have prevented it has been distributed to shareholders for years. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication.